Hey guys, Angel here with the Bullish Bears team. I am making this video today on stock market terminology. So if you're new to the stock market and you're hearing everybody talk with these words that you just don't understand, especially if you are in a trade room or you're on our Facebook fan page or our group or in one of our trade rooms, we have a day trade, swing trade, and futures trade room, and you may be in there and hearing some things that you're just not too familiar with. So I thought I'd make this video just to go over some things. That way you can have a good understanding of these terms, so that way you can talk to people and you can understand what they're saying back. So we're going to start out with the basics. We have a 52-week high and low, which is when a stock hits a yearly high or a yearly low. Then you have after hours, when trading is done after the market closes. If you trade options, then you can't trade after hours. You can only trade those during market hours. And then there's the ask and the bid. Sometimes if you're watching our watch list videos, you'll hear Lucian say something about the bid-ask spread. And the ask is a price the seller is willing to sell for. So it's the lowest ask price, most commonly referenced. And then the bid is the price the buyer is willing to buy for. So if you're going to go and buy a stock, and I don't know if anything will be up right now because it is after hours, but we can always look at options chains and you can see the bid and the ask right here. So you as a new trader, if you were wanting to sell something, you would be selling at these prices here. If you wanted to buy, you would be buying at these prices here. Obviously that's for options. If it's for a stock, it's going to be a little bit different, but we don't have that information right now. Let me see if, yeah, see, after hours there's nothing going on, so you can't see what people are looking to sell like stocks for. And then there are breakouts. And that is not when your face breaks out because you've been eating chocolate. No, it's when a stock breaks out above a previous resistance level. So support and resistance are really big deals when it comes to trading, and you find your support and your resistance through candlesticks. So like a candlestick here, candlesticks are the name of the game. They're the foundation of trading. It shows the highs, the lows, the open, the close, and how traders were feeling. So you can see with this candle right here, it opened up around here, and then it was just bearish on the day, so it closed around here, where you can see this one opened up down here and closed up here. So you can see that there was a bearish bias for the day and then a bullish bias for the day. Now, if you're into shorting these candlesticks, then you're going to do something called covering your position. So when you're short, you're going to borrow shares from your broker, and you would have borrowed them around here, and then as it fell, you would have covered probably down around here. So covering means you're going to buy back the shares that were sold to short. There is also the float, which is the amount of shares available to the public. So you'll hear stocks, especially in the trade room, being referred to as low float, medium float, or high float. So if you look over here, you can see shares outstanding over here. So that tells you, like, if you see this GSAT has all of these shares, so that means that's a pretty high float. Now this isn't the float per se, because float's a little bit different, but the shares outstanding just lets you know if there's a lot of them, it's going to be higher. If there's little, then it's going to be a lower float stock. And then earnings. Everybody's heard of earnings because it's earnings season right now. That's when a company files their quarterly annual report of their financials, which then can cause stocks to gap up or gap down. So if we, actually, let me just make this one chart. If we take a look at Amazon, let's see if, I know they had a gap last year around earnings. They did not this year. So we'll go take a look right, whoa, that's too big. Whoa. So you can see that they had their earnings and they closed, actually with this little red candlestick, they closed at 971.30. When it opened the next day, it opened at 1,055.34. So if you were in this trade at earnings, when it gapped up, you could have made a lot of money. And the opposite can also be true. When something gaps down, then it could have opened up here or closed up here and then opened like down here. So gap up, gap down. If you're going to go long, that means you're buying the stock with the intentions of selling at a higher price. So you'll hear somebody say, I'm going long on this trade. That doesn't mean that they're holding for years or months or days. It just means that they're going up as opposed to taking a short position, which is going down. So if you're wanting to short and you want to know if there's a stock, you can. Of course, it's not going to show on here, but you'll see these hard to borrows, easy to borrows right here. So if you see HTB, that's hard to borrow. That means the stock is not readily available to short. So if you wanted to short a stock that was hard to borrow, you may be charged an additional fee trying to short those hard to borrow stocks. Easy to borrow means it's easy for them to give you shares to short. Apparently that's quite the tongue twister for me. Shares to short, and then you're all good. And you might have heard of level 2, which is down here. It shows you what market makers are doing, and market makers are responsible for facilitating the buy and sell orders and maintaining the liquidity in markets. So market makers can manipulate the market, but they are responsible for all the volume and the liquidity that you see. Like, you need liquidity to trade. It's a very important thing. And so if you're not a person that has a huge account, then you're going to be under the Pdt Rule, which is the pattern day trader rule. And it's an SEC rule limiting traders with accounts under $25,000 to a maximum of 4 day trades in 5 days, which is something that has made me a big fan of swing trading, because I can buy a stock and just hold it overnight and sell it the next day. So that gets me around that Pdt rule, and then I can take my 3 or 4 day trades a week. And then if I'm in a position, because I trade the higher price stocks, that is pretty good, that I know I'm going to have a profit the next day, then I will hold it overnight. So let's actually get rid of this level 2 and go back to the futures, because we're going to talk about red to green or green to red, which is, you can see here, this was a red to green day, and then it went from let's see if there's a green to red. I mean, this typically happens intraday. Let me see if I can actually just show you guys that and bring back up. So you can see, whoa, it went from green to red, and it went down a little bit. Then it went from red to green. So it's when a stock goes from being up on the day to being down on the day, or vice versa. And we're gonna also talk about risk and reward. So risk is how much money you plan to risk on a trade, as opposed to the reward compared to how much you expect to gain. So you'll hear something like you want a 2-to-1 profit loss ratio, which means you're risking like 10 cents to make 20 cents. You wouldn't want to risk 50 cents to make 10 cents, because then there's a much larger chance that you're going to end up losing that 50 cents than you would be making the 10 cents. And let's talk about the spread, because you've heard us say bid-ask spread a few times if you've watched any of our videos. And the spread is the difference between the bid and the ask. And if you're going to be trading options, that's actually something that's pretty important, because you can see the bid and the ask between these two is about $15. So that's quite a lot of money. That means it's going to be really hard to get your order filled or to sell your order with that big of a bid-ask spread. You want a tight bid-ask spread, because the tighter the bid and ask is, the more of a chance you have to get rid of your shares. So let's talk about trend. The trend is your friend. You've probably heard that quite often. It's the general direction of a stock's price movement. So a stock can be in an uptrend or a downtrend. A defined trend is a whole lot easier to trade directionally than a market that is indecisive. So if you take a look right now at futures, it is, let me clear these crazy drawings. and draw it out and see what it is right now. So if we draw just based off of this, you can see that we are in a symmetrical triangle, which is a neutral pattern. That means it could go either way. So you can see it's been smacking around in here, and so it's very, very hard to trade when there is not a big trend. So trend is your friend. If you're going to swing trade especially, you need a defined trend. There are option strategies that allow you to trade in these neutral sideways markets, but all in all, you kind of want the trend. And you also want volume. Volume is the amount of shares a stock trades for a given period of time. So if I'm making the watch list video and you guys are watching any watch list videos that I put out, and we could take a look at what is going on? Okay, we'll take a look at this right here, EYEG. And we can pull up the chart, and obviously I wouldn't put that in there because it's too close to the moving averages. You'd have about a 4-cent profit potential, but you can see that there is a low volume compared to the amount of shares. So like this TTNP would be something that I would potentially look at because there is quite a bit of volume to the shares, although I would not put that on because it's trading between the moving averages. So these are just some of the stock market terminology for you guys. If you want to read it in written form, we have a blog post here, and you can read about all of these different terms, and it's especially great if you're new. You can print it out, you can bookmark it, you can save it if you need to reference something like the bid-ask spread. Sometimes I myself can forget what the bid and the ask is, because to me, the ask would be like what people are willing to pay. Like I'm asking you to like buy this instead of I'm asking you to sell it at this price. So sometimes I get a little like, they sound too similar to me at times is I guess what I'm trying to say. But you can read this blog post, and you can always come and join our trade rooms, and you can, especially if you're new, it's a great way to just watch what people are doing in the trade rooms, and you can subscribe and you can do the live streaming, and you can watch the guys trade in the morning or talk about support and resistance. It's a really, really great thing. And I hope you guys enjoyed this video. So if you did, just like and share and subscribe to our YouTube channel and follow us on social media. We have Instagram, Twitter, and Facebook, and there are some really funny memes on there sometimes. So I hope you guys enjoyed this video, and I will see you next time.